Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market continued its recovery last week in an odd pattern of significant morning upward gaps. We saw that actually in the NASDAQ Tuesday, Wednesday, Thursday, and Friday, and even extending this strange kind of market into the rest of the day. The market saw some selling bouts that came late in the day. That's really not the normal markets that we have seen here over the recent years, but now all of a sudden it seems like some selling programs are coming in late in the day. Monday, there was a gap to the downside early in the day as there was an increase in tensions between China and the U.S. on evidence that COVID-19 came out of a Chinese lab. And Buffett sold all of his airline stocks and said in his meeting that he's not finding values in the market to buy. Pretty significant negative comments that sent the markets lower. Also, oil, which was down 8% overnight, reversed, and that brought the market back up as it finished up for the day about 8%. So S&P's 500, which was down pretty significantly, turned around and ended up with a slight gain on the day. Tuesday, stocks were up as oil surged to gain around 17%, and the S&Ps had been up about 60 points early in the day, but then they lost half of that or more in the last hour as a sell program, one of those that came this week, hit the market, and we saw some pretty hard selling late in the day. Wednesday, we saw the ADP come out, and that is the private sector, and that lost 20.2 million jobs. Wednesday was the only day that the stock market could move to the downside this week as overnight buying reversed and the selling continued as the bond market got hit pretty hard after the announcement that the Fed planned to raise $3 trillion in the coming quarter. That is just an astronomical number. The bond market suffered the triple whammy as their plans for the government to reopen the economy and this big raise of money that the government has to do. And then Jeremy Siegel, who is known for his super bullish call in the stock market that ended up to be right, came out and he declared the end of the bond market bull. All of that put a lot of pressure on the bond market, and that was weighing on stocks during the day on Wednesday. Thursday, another upside gap. The Eurozone was bought pretty heavily in the morning, despite some horrible economic news, and clearly they're in economic collapse. Bank of England came out and said this is the worst slump in over 300 years for them, and they expect to have a 14% negative GDP growth. And then, of course, more QE likely coming, and that, of course, lifted the markets because no matter what the bad news is, if the government's going to pump more money in, then the markets move up. It was another afternoon, however, where selling came in the U.S. stock market and ended up with only modest gains. Friday, again, another upside gap. Everybody was anticipating the payroll numbers coming out, and there was a report that the U.S. and China were making nice to each other in trade discussions, which is clearly a lie. And then in the morning on Friday, the president was interviewed, and Trump said that he's having a very hard time with China. So who do you believe? Overall, we're going to see a lot more negative news coming out regarding the U.S. and China very clearly, as the president wants to put the blame squarely on them, and potentially rightfully so, for letting the coronavirus spread pretty aggressively before they even let the world know. So that unemployment report came out. It actually was not as bad as feared, but I don't think it's giving us all the full information. Payrolls fell 20.5 million. That's just an incredible number. But they had expected it to be lower by 22 million, so like I said, not as bad. They were anticipating that the unemployment rate would be between 16 and 24%. It comes out at 14.7%, and that isn't as bad as expected either. Now, there are a lot of things in those numbers that look like they could be wrong, or that they just did not catch up in April, because the people that were still working and lost their jobs later in the month may not be counted in there. So that's the big issue, that the number that they're getting may not be real, and that number very well could be up closer to 20%. I think it will be before this is over. So investors are clearly happy, bathing in the fairy dust that's sprinkled over every corner of the economy by the Fed. They're thinking, the government turned off the economy, and they did that to kill the disease. No issue, they can turn it back on anytime they want. Well, that's what they've been trying to do here. And we've seen the Fed funds now drift into negative this week, which is an indication that the markets think the Fed's not done, that they're going to go to negative interest rates. But in the process of them killing off this COVID virus, they killed off a big portion of the economy. And a real rebound could be many months away before we see any of that at all, and then the rebound is likely to be very slow. There are many reports out from economists that are saying this could be years, and I believe that is the case. Then what we're dealing with is, of course, there's lower growth in the economy, lower employment than we had before, and lower earnings, and I've got more to say about that and how that equates to lower real stock valuations. I was reading an article that I think is interesting, and I just want to bring a little piece of that to you right now. And the article was discussing SocGen's an analyst, Albert Edwards, who is known to be negative, known to be a bear, but he came out with some information there that it's data, and I think it's really important to talk about it. The article discusses earnings and valuations, which has been my focus here. 12-month forward PE is near 21. I mean, that is nosebleed territory. And the long-term growth rate for earnings, that has been plunging. And at under 10% expected long-term growth rate, that is the lowest number in decades. So I want to share with you a slide in here that is, I think, important, because the third part of that is kind of putting it all together. And that is, when you take the PE and divide it by the growth of earnings, it's called the PEG ratio. And that PEG ratio, I want you to see right over here. It is the highest valuations for stocks, well, we've ever seen. The valuations, if you look right over here, it came up to levels never believed you could get to. And that little dip that you see right over there, that's the 35% break we saw in the stock market that brought that valuations down. It was already at a record high. And look where we are right now. So all of this discussion of the markets surviving and everything being okay when COVID-19 is over with, well, I think that's a bunch of junk. And when you look at this valuation situation, the markets are being lifted in some form of exuberance that almost makes no sense. Thank you, Tex, in this anomalous upside move for lifting up the stock market as it is right now. The NASDAQ moving up to where it's plus on the year compared to the S&P 500 and Russell, which are significantly down on the year. And it was just a handful of stocks that have lifted the markets back up. The tech stocks, the stock companies that are doing well in this period of economic crisis, those are the ones that have gotten this valuation up to extraordinary high levels. In the past, when you got up to these extraordinarily high levels, well, the market came down pretty significantly, but nothing like the level that we see right over here. Talk about the tech stocks. Bank of America came out with a report that we, for the first time this week, saw outflows of money from the tech stocks. So investors redeeming about $43 million. It's not the biggest thing that could happen, but it's the first week of the year that we've seen money flowing out of techs. So they're still going up in this, fairy dust, this fantasy land that the investors are living in right now. But the risks are bigger than ever, as you can see right now. Fantasyland, that's where we are when you look at that. A really, really tough spot for this stock market to be able to expect to make any real significant upside movement. Before we get to that slide, just back over here, for the week, the stock market up like 3.5% to 5%, depending on what index you're looking at. Russell gains over 3% on the day on Friday, which puts it up over 4% on the week. Bond market 30 years down about a point. They've been bouncing all over the place here right now, and yields only up about 0.2 of a basis point for the 10-year yields. Gold is up about $5 on the week. But what's significant is silver. Silver gains about 70 cents on the week. That's up almost 5% on the week. And I've talked recently about the fact that we're entering into a period of an expectation of silver overperforming, that silver-gold ratio coming in significantly. I think that we are entering that stage right now. And what I think that's going to mean is that silver is going to actually lead gold in what I think is going to be a romp to the upside. But of course, you've heard me say that before, and if you look at some of our analysis over this last few months in gold, we have been great. So I believe that gold is in for a much better time. It just needs a little bit of time to fix this correction it's in, and then it'll be off to the races. The dollar up about 1% on the week, and oil gains about $4.25, $4.25, 28% gains on the week. At midday here, that's when we're recording this. So that is a pretty good gain for oil. And we have done some videos this last week discussing interest rates and the relationship to oil. And those are very interesting. You should go look at our big picture analysis on Thursday where we talk about that. Please do go to YouTube. If you're not watching this on YouTube, like this video, give us a thumbs up. Subscribe to this channel. We put so many videos out now every single week, just an amazing amount of great information. And please do share that with anybody you know would be interested in the markets. Follow on Twitter at askSlim. And for our trial memberships, write to Matt at askSlim.com. I've got some discussion about the only trial membership that we are running right now that I think you're going to be very, very interested in if you have followed my analysis here. And that is our cycle analysis workshop. This is an important announcement about that because it's really the final reminder. We've been offering a special 30% off that cycle analysis workshop, and it's time to get it right now because we're ending that offer. It ends on May 11th. That's this Monday. So this is the best price we've ever offered on that. I want you to, if you want to learn about it, just go to the askSlim website that you can see right over here, and you'll see that there is a link right over here that says workshops, and then just click on that cycle analysis workshop, and that will take you to the page with a ton of information that you will see. I want to just give you some sense around what this workshop is. It is it is so much more than a workshop, really. It's my life's work. It's all about technical analysis and what I have learned and studied over the last 40 plus years. This is a robust library of more than 20 video modules. It's over 15 hours of instruction, and it's presented by me. It's a deep dive into the core of my technical analytical method, cycle analysis. I cover many technical analysis topics in here. The effect of momentum on cycle patterns, talk about gaps, VTLs, price projections, so much more. Swing high, swing low analysis, and using candlesticks to identify peaks and troughs. I just want to give you a little peek of that right over here. I'm going to go into the cycle analysis workshop so you can get a picture of what that looks like. There's your page where actually, if you're a member, you get into this workshop, and you can see all of the video modules right there. Just by clicking on the video modules, you then get into each of those 20 videos that you see right in here. Just want to give you a little picture. Let's click on the one, number 11, that shows you about using candlesticks to identify peaks and troughs. Those are cycle peaks and troughs. And I'm just going to click on that, and it's going to bring me not into that right site. Okay, well, I'm not going to be able to show you that right now. I thought I had that up for you to see. No, I guess I don't. So this is the cycle analysis module 11, and what that does is it gives you a very clear picture of how to use candlesticks. Plus, there are 4 other videos on there from our cycle analysis workshop, and that give you a very good picture of how other things out of our library will help you. 4 other library videos that are in there, and you will get a ton of information. We have more than 20 of our additional videos that are in here embedded from our library. In each of these video modules, there is so much more that you'll see in there, and I really want to encourage you to go there and go to that page of the workshop and see all of that information. The cycle analysis workshop special, you're going to learn my method of analysis developed over 43 years. 2 years took me to write it and over 6 months to produce. 20 video modules plus many tools for text videos. You'll never look at charts the same way after you've done this. Just go to askSlim.com, that workshop page, and write to Matt, and he's going to give you show you a new demo reel with clips from most of the videos that are in there, so you'll get a good idea about what's in this amazing workshop. Special 30% discount, that's going to end Monday, May 11th. Write to Matt at askSlim.com for more information or that special 30% off link. That's it on the cycle workshop, and the end coming in just 3 days of this very special price. All right, so now we're going to get right into the short-term view for the coming week. This is a little different because I'm not going to do the best and worst. I'm going to bring that only now every other week to the Market Week show and bringing in other things for you to see. So this week we're going to jump right into the short-term view of the 5 major markets. I always like to be accountable to what I did and said the previous week. Now we're looking at 1 to 3 weeks out. So some of the things didn't quite mature yet as expected. An example of that would be the bond market, which moved lower but didn't really accelerate down to the levels yet that we expected. So we get only partial credit for that. The light crude market was a bit stronger. We get almost full credit for that, but it acted pretty much as we expected. And the stock market, we get no credit for that because the stock market we expected would begin would go down low to a lower level than it did, and then would have a rebound setting up another decline. It didn't quite take that shape, so we're not going to give ourselves any credit for the stock market at all. So let's jump into the light crude market right over here. We'll do 5 markets here: light crude, gold, the dollar, the bond market, and the S&P 500. So what we're expecting right in here is a rally that got us up into the lower portion right over here. We were picturing it to stop there, but it actually got through in here. Our upside projection was 2135 to potentially 25, and now we have upgraded that, as you can see in here, as these resistance zones are a little higher. We're still looking for a decline in here. We talked about the risk of this market getting sold because of the storage issues. We still think that's going to happen, and you can see that. Right now we're going to kind of look for it to chop in this resistance area right there. That high was around over 26. It might try to pop up there again, but then there's risk that it's going to move down here over the next couple weeks. The downside target we're really looking at in here is around 1630, right at the bottom right here. Potentially 1830 would be the low, but we don't see much more upside in here, and then we see the market getting nervous and moving down one more time into the roll time for the near-end contract. So the range that we're looking at right now, probably 3030 is the best we could see it, but 26 and a fraction, probably that old high, is where it's going to struggle, and getting down to this 1630 area here in some panic out over here into mid to late May. Then I think things will be better, and we're going to be getting back up into that 30 plus area right there. Again, as we now have raised our targets and expanded the range a little bit, and here what we're looking for. Some of the evidence really is that the bottom is in. We've had momentum improve to neutral right over here, and that is a better sign also. And we're just going to look for that wide range right in here with some pretty bad selling coming in at times in there. So that is a look at the light crude market. Now we're going to look at the gold market. And this is the gold daily. Had some emails saying that for future speak we didn't use this daily chart. Actually meant to, but this is the most current daily chart. And what we have in here is a low that really looks like it was made right here. That low lines up. You could see that's the gold right in here. This is the silver, the dashed line. So the low here, perfect. You can see the cycle, the cycle, the cycle, and then the rally phase right in here. Problem is that the intermediate pattern, the correction, does not look complete to us. So that says that we're probably going to come down out to here. It might even lengthen out even a little bit more out over here into June. We're not 100% sure about that, but the silver market looks like it's going to take off over here, and that's why we think that this is the silver outperform period. So we think it's going to help the gold market from having much of a correction. And again, gold at any time, based on the pattern we see in here, could finish this corrective period and take off, even if it did it right here with silver. So the patterns are suggestive of the fact that we're still in a sideways correction. The range in that sideways correction is about 1765 right over here. You can see this resistance area is right there from this cycle peak and this cycle peak. And so that's kind of the resistance area right there. The support area comes down around here with this number right around the 1680 level. And that's what we see. And over this area right over here at 1790, when it does that, it could explode. And I think it's going to go to new highs when it does that. So momentum got lost. There's a little blue arrow there that you can't quite see. I think I'll just make this bigger for you. And that momentum in here, you see the slim ribbon tightening up right over here. That's not a great occurrence when that happens. and that says that we're getting some chop period in here, and that's why I think that it's not ready to go yet on the upside. Some of the evidence is suggestive that this correction will end soon in some number of weeks, and that silver might very well be just at the starting line to be moving up pretty significantly soon. So silver, a good example today. Gold is down $10. Silver is up 17 cents. And that is, I think, the beginning of something happening in that area. So watch for that silver-gold ratio to really come in. And we're going to look for gold to be still in this range-bound looking pattern in here until it completes this correction and then takes off. The market is subject, of course, to the dollar actions, and we'll look at the dollar right now. Here is the dollar, and you can see that amazing narrowing pattern that you see right over here. This is actually, we believe, a big diamond that's forming, and I think it's ultimately going to be a major top. So that's the sum of the evidence that we have this big diamond, and it's likely a top that's forming, but now it's stuck in this narrow range. We're going to look for the dollar to just chop around in here and then move down again. The key is, and these are VTLs, we just talked about the cycle analysis workshop and valid trend lines. You'll learn about that in the workshop. They're a little different than regular trend lines in that they measure, they're set up from cycle peaks and troughs versus just longer term tops and bottoms. So it's a little bit different, and they tend to be very informative when you move through these levels. So you can see we're just now moving in towards this focal point here. And I'm thinking that at some point you could see this big downward corrective or negative period right in here. That could start the decline that we're looking for in the dollar market, and that could be in alignment with the upward move that we're expecting in the gold market. We're going to look for chop. We're going to look for downward bias in here. And the range that we're looking at right now is about 1040 down over here around 98.90 or so, and we'll probably stay in that for the next week or longer right now while we're in this focal point, and then we think it's ultimately going to be a downside break. Next thing we're going to look at is the bond market /ZB. We have been looking for downward correction to accelerate in here. The market has been in this sideways chop and started to give a little ground this week as we expected. It's down a point on the week, but that's nothing. Our downward targets are over here right at the area of about 175 that we think it'll be. Where's that right there? 175.5 is where we're targeting down to that area. We just think it's going to erode in here and then start to accelerate down. This is about a 2 to 3 week period, we assume. The TLT has got a little longer cycle, so that could go out into June, somewhere out over here. So this is, again, kind of looking at that triangular shape going on. And it's been resistant to any kind of upside move, even though the momentum has been positive. But look at right here, momentum is now turned neutral, so it is weaker. We see that that downward turn over there, or that neutral signal that we see, is the first time since January 15th. So this whole period right over here, where bonds had that big rally, this has all been in a positive momentum condition going up here, and now momentum has neutralized. So that's the first sign. We think it's a pretty good odds that we're going to get that decline that we're looking for. Some of the evidence, we're still in this intermediate corrective period. And please do watch Thursday's big picture analysis video. I talk in there about the bond bear market, and I give you some really interesting charts looking at the yield of the 10-year bond, 10-year note, and how there is a very repeating pattern in there that has us now in a period where yields are likely to be going up. And that, I think, is important information. And I'm going to show you the correlation between yields and oil, and you're going to like that. I mean, there's just some great information there that you will see in that video. So go watch Big Picture Analysis, where I discuss the 10-year notes, yields, and the correlation to oil. So that is a look at the bond market. So now we're going to talk about the stock market. The stock market has moved up pretty steadily here, as I said, and still not getting up to the point where it gapped down from over the 950 area for the S&P 500. It's been driven up by the NASDAQ, which has been super strong. But now I've mentioned earlier in the show also that there is some sign of some outflow of money from those tech stocks, and that is likely to get the NASDAQ to begin to underperform the market and maybe lead the market into a correction. So I do think that the market turning up this week was a little bit early from what we were looking at, but very soon it's likely to be a downward turn. I'm going to show you the S&P 500 now, and you'll get an idea of this very, very messy chart. Now I'm going to show you this period right here that leads up to the peak here for the stock market. I'll give you a little tour of the cycles that we're in here, and you can see, well, this is a little hard to read. There's a 21-day right over there. So this cycle that you see right over here was 21 days. This one was 22 days that you can see right there. And then the cycle pattern started to narrow a little bit. This was 20 days, this was 20 days. So you can see the consistency in these cycles, and we look at that. And look at here where the slim ribbon became positive, and that was the support and driving this market up all the way. This is from October of last year when it turned positive until it started to roll over when we had the big break in March. So that's a look at that portion of the chart. So you could see those rhythms. Now we're going to look at this portion of the chart right over here. And the key thing that we're looking at here is that this cycle, which bottomed here on day 20, also this was day 20, and that was a negatively configured cycle. That was a very strong message after we had seen all of these cycles before that, all positive, each one higher highs and higher bottoms. Then all of a sudden we got this one right over here, which was negative. It set up this failure in the sell zone and gave you this massive break. And we were getting sell indications all the way down, and then it started to improve in this rally. So what's going on right now is that we have kind of a narrowing of time frames going on. This was a 16-day low. This was a 19-day low right over here. And the minor cycle right over here was only 8 days. So we could be dealing with, 17, 18-day cycles in here and a little bit of shortening going on. This is 4 days off of that little low right over here. And it has not gotten back up to that high that it made right there at about 29.50. It's trying, it's really working hard at it, and we do have upside momentum, but this is running out of time. And we have an intermediate pattern that is also in a corrective period that says it will come down for about the next couple of weeks. So we are looking for this rally to stop in here. And we're going to call for a down week in here, getting down to, well, the two targets here. This one right over here is around 27.70 or so. This one right over here is around 26.60, 26.70. And these are the supports off of the weekly charts. So we're going to look for it to get down into this support zone. And that would take some pretty good selling, and it would mean that the NASDAQ is going to have to get involved in here on the downside for that to happen. So this positive cycle here, right-hand translation and swamping, could very well happen here. If it does, the analysis is going to extend out for another potential cycle in here. that will get you above the 29.50. That would be the projection. If we get the failure we're expecting, then we would expect this rally to not be able to do quite as well. Maybe test those areas and then roll over again. So this is a period in here that's very important. And we're going to call for this decline that you see here. A downside move, 2670, 2670, 2770. Those are the downward targets into the support zone. And that would be a pretty significant down week and a half potentially that we're looking at in here. So again, if this is day 8, this is day 12. We're looking for this low to come in day 18, 19, something like that. So that leaves you about a week and a half of some risk in here. And I think we're potentially going to see some pretty good declines. Maybe the news will start to support the fact that, like I said in the beginning of the show, that the economy is no way justifying these levels. You saw me show you the amazing overvaluation in the market when you look at the PEG ratio. And if you didn't watch the beginning of the show, because so many people speed to this right here, go back and watch the beginning of the show, because the that PEG ratio is really important, and we're in a period of massive overvaluation in stocks. The having gotten back up to the 61.8% here in the bigger picture is very normal after a big break like this. And this would be well within the norm, even if it got up to the 78.6% way up here, would be well within the norm of a bear market rally. So those people that are just diving in here because they think it's the right thing to do and the economy is going to get past this and everything is going to be just fine like it was before, again, you're living in fantasy land. And I think the risks are very high for the stock market. And I think this week, for the very, very near term, we're likely going to see some of that with downside risk coming into the market. That is a look at everything that is the short-term view, 5 major markets, and the end of the show. I hope you found the information absolutely fascinating. Do go and write Matt at askSlim.com. This is the last 3 days that you'll be able to get that 30% off on the workshop. And you will learn more about technical analysis in those 20 video modules, plus the 20 special videos we put in there for you from the library. You will learn a ton from that and come out of the other side of that massive amount of studying that you're going to need to do. So well informed about technical analysis, you won't believe how much you've learned and how much it's changed you, the way you look at the charts of the markets. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.